Hey guys, welcome to this week's Money and Investing Show. This week we're going to be looking beyond the headlines. That's right, we've seen the NASDAQ have a terrific run, but it's been a very focused run that's been driven by just a very small number of companies. Easy to fall foul of this particular trap in the market and end up with what we call bad breath. Take plenty of notes, as always, take plenty of action. Enjoy the show. Hey guys, welcome to this week's Money and Investing Show with me, your host, Andrew Baxter, and as always, my co-host and offsider, Mitch Olarenshaw.
Pleasure to be here, Mr. B. As always, thanks for having me on the show. One thing a lot of people, most people hate is bad breath. Now, this is a play on words because we're going to apply this into the stock market. I'm talking about looking beyond the headline and actually reading through to the story.
Indeed, nothing to do with halitosis, all about breadth rather than breath, and that's exactly right. We've seen a very, very interesting phase in the stock market where we've seen the big indices, particularly the NASDAQ, perform very well. But is it all that it might seem? And the answer is no. We like to dig deeper on the Money and Investing podcast, as you know, so let's dive into it. And I guess, as you said, the starting point is I guess it's rather like reading a newspaper. Do you read the headline or do you read the story? Because sometimes they're not the same thing. And in this instance, that's very much the case when looking at the market. You see the NASDAQ is up 17, 18%, but is that really a fair reflection of what the stock market is doing? And I don't necessarily think so.
As you say, it may not be the case. So you look at the headline, as we say, Q1, we've just hopped into April. Q1, great quarter for the NASDAQ and the S&P. The Dow, not so much. However, it's interesting when you actually peek behind the bonnet, or peek under the bonnet, as to which stocks performed very well and which stocks actually didn't perform that well.
85% of the NASDAQ move has been achieved by 8 stocks. If you actually look at the weighted component of the index, in other words, the really big caps, the giga caps, have lifted quite significantly, and they've driven the index much more than pretty much everything else in there.
So it's Apple, Microsoft, Google,
the big guys, and they've performed incredibly well. And by virtue of their size and how much of the index that they make up, they've contributed substantially to that rise up in the index, whereas the other several hundred companies that make up the benchmark, being the NASDAQ, or if we were to talk about the S&P 500, probably 450 of the companies have had a fairly anemic first quarter, but the big guys, the top 10, have really driven it and pushed it higher. So does that mean the market's getting stronger, or is that an easy trap for a young player to fall into?
Potentially. One thing I actually would recommend our listeners, if you're really looking to take this seriously, have a look at the ratio of gainers to decliners on a per day basis or per week basis, however you want to see. You see a big move in markets and you see twice as many gainers to losers on the day or the week, that the market's pretty strong overall. But if that ratio of gainers to decliners is actually quite small, yet you've seen a big move in markets, typically a good flag to say, okay, maybe it was just made up of a single few stocks.
Exactly right. And that's a really smart tip to give our clients. I think, gainers to losers definitely gives you an idea of the breadth of where the run has been in markets. So is it a bad thing? Look, as you know, most of the trading I do is in the ETF space, and I've got trades running on the NASDAQ as we speak right now. And I've been very happy to see the index moving higher. Am I concerned that it's been driven by a handful of stocks? Yes, I am. But as someone that's not focused on picking individual stocks and instead I'm just looking to trade that bigger market, it's a strategy that's worked very, very well. So there are risks in it, of course, and that is that, like any ecosystem, in order for it to thrive, you've got to have all aspects of it performing really well. If we talk about property as an example, the investment market has been incredibly strong. First-time buyers have suffered as a consequence of it. So you need all aspects of a market to really fire in order for it to be robust. And when you see moves like this that are driven by a very, very narrow sector, and not just a narrow sector, but literally a handful of stocks, that to me is a risk on. It's not a buying opportunity where markets are setting new highs. It's actually time to take stock and really look at what risk mitigation and management you've got in play so that you don't find yourself falling foul when those particular stocks have seen their run to its conclusion, and all of a sudden you're running for the exit door like everybody else.
So question to you, AB, in a situation like what we're currently in, as you say, only a handful of stocks making up most of the gains in the movement. What are you doing? What should you be doing? What should you not be doing in that scenario?
Yeah, again, I like trading the index, so I'm almost impervious and immune to the individual stock moves. And that's worked really well. I think at the same time, you've got to take into account that music will stop, and rather like, musical chairs, you better make sure you've got somewhere to go sit. what's of particular concern, I suppose, is that where we are economically and moving into a slower, if not, and let's just pause there for a moment, actually. The tech sector has been cost-cutting like there's no tomorrow. We've seen, substantial levels of layoffs and retrenchment within all of the big caps, where they've got rid of, tens of thousands of staff. And you wonder how much things like, ChatGPT and artificial intelligence are starting to make inroads into some of those,
some of
those roles.
Just got sued for defamation, by the way, ChatGPT.
I bet they self-rep in court.
I'd say so.
I bet they win too.
Yeah, I would say so.
So the notion that the tech sector has been paring its costs is usually a sign that you've got industries that are getting towards the top of the cycle, and their goal is to obviously stay there as long as they can through paring costs to keep their earnings growth moving along. But if we move into a slower economy, the tech sector in particular can be quite viciously sold off. So we're at that flexion point where we've had a very, very strong run in the market, led by the tech sector and led by a handful of stocks within the tech sector that have already been busy cutting costs. Where is the next play? And the answer is likely to be a bit of a tap out and a pullback in that market. And given the fact that it was the big guys that drove the market, it'll be the big guys that then pull it back down. So I'd be extremely cautious towards the market and the NASDAQ at those sort of levels based on what's driven it. So
talking to that, AB, factoring in interest rates for a minute, we've seen quite an aggressive rate hike scheduled by the Fed thus far. There's no meeting this month in April. The next one is in May.
Yep, May the 3rd, I think, isn't it?
Yeah, I think so. And the market's widely pricing in 25 basis points, which is a stellar difference from when it was once 75 basis points, for example. If we start to see a slowdown in interest rate hikes or a pause, for example, does that change the narrative for tech?
I don't necessarily believe it does, in that there's a reason why interest rates are slowing down. The medicine is starting to take effect. We've seen that with some of the anecdotal inflation data and personal consumption and things like that are starting to show that the move by the Fed has worked. But there is a lag factor for this in there, and whether at the top of the rate cycle or not, I think we're going to start to see that continued slowdown in the US economy. Just because rates aren't going up anymore doesn't mean to say the economy is all of a sudden going to take off, because we may see a period of 7, 8, 9 months where the Fed hold rates at that level, and sort of targeting, let's call it a soft landing, where we're not looking to push the economy into a recession, but we are needing to take some air out of the balloon from inflation and let that take its effect and see that economy just slow down a little bit and just make sure that very, very stubborn inflation is knocked out. I think it'll be a while before the rump is knocked out. It'd be like a limpet holding onto the side of a rock, whereby the headline inflation is declining, but you're going to have that residual 3.5%, 4% that's going to be really, really hard to sort of chisel off the rock.
Yeah, it's just interesting you say that, and it could be a long while before we start seeing interest rates come down as well. And as you say, the economy, the only reason they would pause on interest rates is if the medicine's really starting to take effect.
Well, the other factor too to consider is a notion of slightly tighter credit markets too, with Silicon Valley Bank falling over and banks, plumping up their reserves, if you will. That takes a lot of liquidity out of the market, takes a lot of working capital out of the market, and by its very nature, that will have a slowdown effect on earnings over time. So again, the tech sector isn't going to be immune to that either.
So talking about breadth here again, AB, if we did see a sell-off in the tech sector, do we expect to see the similar type scenarios to where we saw the gain, where there's only a handful of stocks which pull back or a handful that survive, or is it sort of the ship sinks altogether?
Yeah, look, I don't think we're looking at the ship going down, but I think the very nature of what propelled it up is going to be what propels it down. Just by the fact that the valuations are more stretched in those kinds of stocks, and to see those retreat to a normal level will mean that they'll pull the market down with the same level of gusto that they've driven it higher. So it is something to be very, very minded of. And again, an ETF versus individual stocks. At least with the ETF, you're immune to the stock specific move, but you'll still be affected. In terms of the pullback in the market. I guess the flip side is you can short the tech sector fairly easily with things like SQQQ, which is a triple geared, not for everybody, but a triple geared ETF to the downside. And if we start to see, the big tech companies coming off, then SQQQ will provide a great place to capitalize on that.
Anything else you would suggest traders out there look at doing? Maybe some volatility plays?
everyone's at different stages of their trading journey. And we always advocate, you start from the top down. So look at the index, look at what the market has done. And I think more than anything, what this conversation highlights is the importance to read past the headline. And even if you're someone that's time poor and you're just very quickly scanning through what the market did, understanding what's driven it is very, very important. And, tips like, for example, your use of the gainers versus losers to just go, okay, well, that actually is really skewed, that there's a very, very small number of gainers and a lot of losers there, yet the market's gone up, would provide the narration, if you will, for this conversation, and understand that anything that's sort of built on a single pillar is very, very wobbly. You need something that's broad-based to be stable. And so read past the headline, use the gainers and losers ratio over time, and you could look at it on a daily session. It doesn't, it's a very, very short time frame to consider. Looking at bigger, 1 week, 1 month, 1 quarter type figures is probably a bit more robust when you're looking at the gainers versus losers. Secondly, having laid that in, then look at where the big weight players are in the index and see how they've performed, and see if it is those stocks that are really driving it. And if that's the case, then that's a very good warning indicator that this isn't a broad-based recovery in the market at all. It's a very narrow band of outperformers that when the conditions shift and that perfect storm that's working for them right now is no more, then you're going to see a fairly nasty sell-off too. You have to get past the headline. So your evolution as a trader, look at the headline, see what the market's doing, and then start to dig a bit deeper, lift the bonnet, gainers versus losers, then look and see within those gainers and losers what the gainers and losers were. And if they're the giga caps, which has been the case here, you can tell that it's a very narrow driving force in the market, and that is never a good situation. It's always a very fragile foundation on which to build a case. And a lot of investors will be looking at that first quarter thinking, gee, I've missed out, I've been a little bit late to the party in terms of getting in, or maybe I've been a bit too cautious this time. And we could prove to be very wrong on this comment, but we're about to go into an earnings season right now. It'll be interesting to see exactly what that earnings season looks like. We've got lower consumer activity based on higher interest rates. There's a semi-credit crunch, I suppose, that's going on the back of Silicon Valley Bank, where there's less liquidity in the market, and that will impact on working capital, it'll impact on margins, it'll impact on earnings through here. We've also got expectations of earnings that are incredibly low. And just because companies come out with results that are slightly better than a very mediocre expectation of earnings doesn't mean it's a buy case. And I think we are in for a bit of a choppy time through this next quarter. You wouldn't get that just looking at the index. You need to dig deeper to see why it's been moving ahead. And maybe FOMO isn't a feeling that should be washing over you right now. It's maybe, okay, that definitely has happened, but maybe it's starting to get to that flexion point where it's looking a bit wobbly and risk management kicks in, and I'm not going to chase the wind here and try and get onto that train. It's already gone.
You heard it here first. AB, great advice. Thank you very much.
Absolute pleasure, anytime. There you have it, guys. Make sure you like, comment, subscribe. Most importantly, hit that notification button, and we'll look forward to hosting you next week.